Good morning everyone, I am AILEEN and I will be explaining the first part of this topic, the financial statement analysis. The financial statement analysis is largely a study of relationship among the various financial factors in a businesses as disclosed by a single set of statements and a study of the trend of these factors as shown in a series of financial statements. By establishing a strategic relationship between the items of a balance sheet and income statement and other operating data, the financial analysis explains the meaning and significance of such items. The term analysis and interpretation are complementary to each other, though sometimes they are used distinctively. While analysis is used to mean the simplification of data by methodical classification of data given, in the financial statements, the term interpretation means explaining the meaning and significance of data so simplified. However, analysis is useless without interpretation, and interpretation becomes difficult without analysis. Financial analysis is the process of evaluating businesses, projects, budgets, and other finance-related transactions to determine their performance and suitability. Typically, financial analysis is used to analyze whether an entity is stable, solvent, liquid, or profitable enough to warrant a monetary investment. If conducted internally, financial analysis can help managers make future business decisions or review historical trends for past successes. If conducted externally, financial analysis can help investors choose the best possible investment opportunities. Fundamental analysis and technical analysis are the two main types of financial analysis. Fundamental analysis uses ratios and financial statements data to determine the intrinsic value of a security. Technical analysis assumes a security's value is already determined by its price and it focuses instead on trends in value over time. Now, understanding financial analysis. Financial analysis is used to evaluate economic trends, set financial policy, build long-term plans for business activity, and identify projects or companies for investments. This is done through the synthesis of financial numbers and data. A financial analyst will thoroughly examine a company's financial statement, the income statement, the balance sheet, and cash flow statement. Financial analysis can be conducted in both corporate finance and investment finance settings. One of the most common ways to analyze financial data is to calculate ratios from the data in the financial statements to compare against those of the other companies or against the company's own historical performance. For example, the return on assets is a common ratio used to determine how efficient a company is at using its asset and as a measure of profitability. This ratio could be calculated for several companies in the same industry and compared to one another as a part of larger analysis. The corporate financial analysis. In corporate finance, the analysis is conducted internally by the accounting department and shared with management in order to improve business decision making. This type of internal analysis may include ratios such as net present value and internal rate of return to find projects worth executing. Many companies extend credit to their customers. As a result, the cash receipt from sales may be delayed for a period of time. For companies with large receivable balances, it is useful to track days sales outstanding, which helps the company identify the length of time it takes to turn a credit sales into cash. The average collection period is an important aspect of a company's overall cash conversion cycle. A key area of corporate financial analysis involves extrapolating a company's past performance, such as net earnings or profit margin, into an estimate of the company's future performance. This type of historical trend analysis is beneficial to identify seasonal trends. For example, retailers may see a drastic upswings in sales in the few months leading up to Christmas. This allows the business to forecast budgets and make decisions such as necessary minimum inventory levels based on past trends. Investment financial analysis. In investment finance, An analyst external to the company conducts an analysis for investment purposes. Analysts can either conduct a top-down or bottom-up investment approach. A top-down approach first looks for macroeconomic opportunities, such as high-performing sectors, and then drills down to find the best companies within that sector. From this point, they further analyze the stocks of specific companies to choose potentially successful ones as investments by looking last at a particular company's fundamentals. A bottom-up approach, on the other hand, looks at a specific company and conducts a similar ratio analysis to the ones used in corporate financial analysis, looking at past performance and expected future performance as investment indicators. Bottom-up investing forces investors to consider microeconomic factors first and foremost. These factors include a company's overall financial health, analysis of financial statements, the products and services offered, supply and demand, and other individual indicators of corporate performance over time.
Hi everyone, I'm the second reporter. My name is FORONDA, and I will be discussing about the types of financial analysis, examples of financial analysis, why is financial analysis useful, and how is financial analysis done. Types of financial analysis. There are two types of financial analysis, the fundamental analysis and technical analysis. What is fundamental analysis? Fundamental analysis uses ratios gathered from data within the financial statements, such as a company's earnings per share or EPS, in order to determine the business value. Using ratio analysis in addition to a thorough review of economic and financial situations surrounding the company, the analyst is able to arrive at an intrinsic value for the security. The end goal is to arrive at a number that an investor can compare with a security's current price in order to see whether the security is undervalued or overvalued. While technical analysis uses statistical trends gathered from trading activities such as moving averages or MA. Essentially, technical analysis assumes that a security's price already reflects publicly available information and instead focuses on the statistical analysis of price movements. Technical analysis attempts to understand the market sentiment behind price trends by looking for patterns and trends rather than analyzing a security's fundamental attributes. Examples of financial analysis. As an example of fundamental analysis, Discover Financial Services reported its fourth quarter 2020 earnings per share at $2.59 that was up from the third quarter 2019 earnings per share of $2.25. A financial analyst using fundamental analysis would take this as a positive sign of increasing the intrinsic value of the security. With that, future earnings per share projections may also be forecast to rise. Why is financial analysis useful? The goal of financial analysis is to analyze whether an entity is stable, solvent, liquid, or profitable enough to warrant a monetary investment. It is used to evaluate economic trends, set financial policy, build long-term plans for business activity, and identify projects or companies for investment. How is financial analysis done? Financial analysis can be conducted in both corporate finance and investment finance settings. Financial analysts will thoroughly examine a company's financial statements, the income statement, balance sheet, and cash flow statement. One of the most common ways to analyze financial data is to calculate ratios from the data in the financial statements to compare against those of other companies or against the company's own historical performance. A key area of corporate financial analysis involves extrapolating a company's past performance, such as net earnings or profit margin, into an estimate of the company's future performance.
What is fundamental analysis? Fundamental analysis uses ratios gathered from data within the financial statements, such as a company's earnings per share, in order to determine the business value. Using ratio analysis in addition to to a thorough review of economic and financial situation surrounding the company, the analyst is able to arrive at intrinsic value for the security. The end goal is to arrive at a number that an investor can compare with the security's current price in order to see whether the security is undervalued or overvalued. What is technical analysis? Technical analysis uses statistical trends gathered from trading activity such as moving average. Essentially, technical analysis assumes that a security's price already reflects all publicly available information and instead focuses on the statistical analysis of price movements. Technical analysis attempts to understand the market sentiment behind price trends by looking for patterns and trade rather than analyzing in a security's fundamental attributes. Types of financial analysis. The most common types of financial analysis are vertical, horizontal, leverage, growth, profitability, liquidity, efficiency, cash flow, rates of return, valuation, scenario and sensitivity, and the last one is the variance. First is the vertical analysis. Vertical analysis. This type of financial analysis involves looking at various components of the income statement and dividing them by revenue to express them as a percentage. For this exercise to be most effective, the result should be benchmarked against other companies in the same industry to see how well the company is performing. This process is also sometimes called a common size income statement, as it allows an analyst to compare companies of different sizes by evaluating their margins instead of their dollars. So next one is the horizontal analysis. Horizontal analysis involves taking several years of financial data and comparing them to each other to determine a growth rate. This will help an analyst to determine if a company is growing or declining and identify important trends. When building financial models, there will typically be at least 3 years of historical financial information and 5 years of forecasted information. This provides 8+ years of data to perform a meaningful trend analysis, which can be benchmarked against other companies in the same industry.
Leverage analysis. Leverage ratios are one of the most common methods analysts use to evaluate company performance. A single financial metric, like total debt, may not be that insightful on its own, so it's helpful to compare it to a company. Total equity to get a full picture of the capital structure. The result is the debit or equity ratio. Common examples of ratios include debt or equity, debt or EBITDA, and EBIT or interest. Growth rates. Growth rates are analyzing historical growth rates and projecting future ones are a big part of any financial analyst's job. Common example of analyzing growth include year-over-year, regression analysis, bottom-up analysis, starting with individual drivers of revenue in the business, and top-down analysis, starting with market size and market share. Profitability analysis. Profitability is a type of income statement analysis where an analyst assesses how attractive the economics of a business are. Common example of profitability measures include gross margin, EBITDA margin, EBIT margin, and net profit margin. Liquidity analysis. This type of financial analysis that focuses on the balance sheet, particularly a company's ability to meet short-term obligation. Short-term obligation means those due is less than a year. Common examples of liquidity analysis include current ratio, acid tests, cash ratio, and net working capital. Efficiency analysis. Efficiency ratios are an essential part of any robust financial analysis. These ratios look at how well a company manages its assets and uses them to generate revenue and cash flow. Common efficiency ratios include asset turnover ratio, fixed asset turnover ratio, cash conversion ratio, and inventory turnover ratio. Cash flow. As they say in finance, cash is king, and thus a big emphasis is placed on its company's ability to generate cash flows. Analysts across a wide range of finance careers spend a great deal of time looking at companies' cash flow profiles. The statement of cash flows is a great place to get started, including looking at each of the three main sections: operating activities, investing activities, and financing activities.
Join me, Belga, your fifth presenter, and today I will going to present to you the following: the common example of cash flow analysis, rates of return, common example of rates of return measures, valuation analysis, scenario and sensitivity analysis, variance analysis, financial analysis as a best practice. So let's start at the common example of cash flow analysis. First is the rates of return. At the end of the day, investors, lenders, and finance professionals in general are focused on what type of risk-adjusted rate of return they can earn on their money, as such as assessing rates of return on investment, or the ROI, is critical in the industry. We have the common examples of rates of return measures. First is the return on equity, or the ROE. ROE is a measure of financial performance calculated by dividend or net income by shareholders' equity. Because shareholders' equity is equal to a company's assets minus its debts, ROE is considered as a return on asset. ROE also is considered as a gauge of a corporation's profitability and how efficient it is generating its process. The next example is the ROA, or the return on asset. An ROA is an indicator of how profitable a company is relative to its total assets. ROA gives a manager, investors, or analysts an idea as how efficient a company's management it is at using assets to generate its earnings. The next one is the ROIC, or the return on invested capital. ROIC is a calculation used to assess a company's efficiency as allocating the capital under its control or profitable investments. ROIC gives a sense of how the company is using its capital to generate profits. Dividend yields. A dividend yield is expressed as a percentage. Is a financial ratio, dividends, or price that shows how much a company pays out in dividends each year relative to its stock price. Another example is the capital gain. A capital gain is an increase of capital or in capital of assets value, and it's considered to be realized when the asset is sold. AAR, or accounting rate of return, is a formula that reflects the percentage rate of return expected of an investment or asset compared to initial investment cost of AAR formula, dividends, and asset average revenue. The company's initial investment to derive the ratio or return that one may expect over lifetime of the assets or related project. AAR does not consider the time value of money or cash flow, which can be an integral part of maintaining a business. Last example is the internal rate of return, or the IRR. So, IRR is a metric used in financial analysis to estimate the profitability of the potential investments. IRR is a discount rate that makes the net present or present value, the NPV, of all cash flow equal to zero is discounted cash flow analysis. Now let's proceed to the valuation analysis. Valuation analysis, the process of estimating what a business is worth, is a major component of financial analysis that professionals in the industry spend a great deal of time building financial models in Excel. The value of the business can be assessed in many different ways. The analysts need to use a combination of methods to arrive a reasonable estimation. So we have the approaches to valuations includes, the first one is cost approach. Is a way of being in which a coach, professionals, managers, team leader, advisor guides the player or the client, employee, team member in the pursuit or result, mastery, and becomings through expanded awareness, focused actions. So next is the cost to build or replace. So what is this talk about? Replacement is a cost of term referring to amount of money a business must currently spend to replace an essential assets like real estate. Relative value or market approach. Relative value is a method of determining an asset worth that takes into account the value of similar assets. In this contrast with absolute value, which looks only at an asset intrinsic value and does not compare it to other assets. The price to earnings ratio, or the P/E, is a popular valuation method that can be used to measure the relative value of the stocks. Another is the comparable company analysis. So, it is a process to evaluate the value of company using the metrics of other businesses of similar size in the same industry. The other one is the precedent transactions. It is an analysis, is evaluation method in which a price paid for similar companies in the past is considered an indicator of what companies value. Now let's go to the intrinsic value. So, intrinsic value is a measure of what an asset is worth. So, this measure is arrived at by means an objective calculation or complex financial model, rather than using the currently trading market price of that assets. The discounted cash flow analysis. It is a valuation method used to estimate the value of an investment based on its expected future cash flow. DCF analysis attempts to figure out the value of an investment today based on the projections of how much money it will generate in the future. This applies to the decisions of investors in company or buying stocks, and for business owners and managers looking to make capital budgeting or operating expenditures decisions. Scenario and sensitivity analysis. Another component of financial modeling and valuation of performing scenarios and sensitivity analysis as a way of measuring risk. Since the task of building a model to value a company is an attempt to predict the future, it is inherently very uncertain. Building scenarios and performing sensitivity analysis can help to determine what the worst case or what would be the best case in the future for companies could look like. Managers of businesses working in financial planning and analysis, or the FP&A, will often prepare these scenarios to help a company prepare its budgets and forecasts. Investment analysis will look at how sensitive the value of a company is at change in assumptions flow through the model using goal seek and data tables. So we have also the variance analysis. Variance analysis is a process of comparing actual results to a budget or forecast. It is very important part of internal planning and budgeting process at an operating company, particularly for professionals working in accounting and finance departments. And we have also the financial analysis best practices. All of the above methods are commonly performed in Excel using a wide range of formulas, functions, and keyboard shortcuts. Analysts need to be sure they are using best practices when performing their work. given an enormous value that is stake at the propensity of a large data sets to have errors. We have also here examples of best practices. First is being extremely organized with data. Second, keeping all formulas and calculations as simple as possible. Third, making notes and comments in cells. Fourth, auditing and stress testing spreadsheets. Fifth, having several individuals relative to work. Sixth, building and redundancy checks. Seventh is using data tables and charts or graphs to present data. Eighth, making sound database assumptions. 9. Extreme attention to detail while keeping the big picture in mind. And lastly, the statements by interpretation. Many to covers both analysis and interpretation together used it.
Hello everyone, my name is GLENDA BALOG, reporter number 6 of Group 4. So I will discuss the objectives of financial analysis, 4 elements of financial analysis. Financial analysis help us make decisions, techniques, and theoretical challenges. So first is objectives of financial analysis. Different parties are interested in the financial statements for different purposes and look at them from different angles. For example, the debenture holders analyze the statements in order to ascertain the ability of companies to make regular period interest payments and final payment of principal amount on maturity. The prospective shareholders would like to know whether the business is profitable and is progressing on sound lines. Above all, the management is interested in the operational efficiency as well as the financial position of the business. Hence, the objective financial analysis is to make detailed study about the cause and effect of the profitability and financial condition of the firm. 4 elements of financial analysis. In a typical analysis, we usually review the profitability, solvency, liquidity, and stability of a project or business. First is profitability. Let's suppose we are analyzing a project. We must first determine whether it will be profitable. In other words, will it make money? For example, a profit. Will the financial reward be worth the risk? Second is solvency. If we are analyzing a company, we need to determine whether its debt are too high. A company's solvency, its ability to meet long-term financial obligations. To determine solvency, we divide total assets by total liabilities. A total of 1 or more means the company is solvent. If the total is less than 1, the company is insolvent. In other words, the company is unlikely to be able to meet its long-term financial obligations. Third is liquidity. Liquidity refers to how much cash a company has or how quickly it could access cash. A company's liquidity tells us how easily a company can pay its bills. The most liquid of all assets is cash. A business must be able to do 2 things at the same time. First is maintaining positive cash flow. Second is pay for the things it needs immediately. Fourth is stability. When making plans, business people hate instability more than anything else. Being able to make medium-term and long-term plans is important. This is not possible if a business is unstable. Stability is not only important at company level, but also at national level. Financial analysis help us make decisions. So we have 5 financial analyses that help us to make decisions. After carrying out a financial analysis, senior management and investors can better determine whether to shut down part of a company or keep it going. It might also help people decide whether to sell it. Second is go ahead with the project. The analysis could also help decide whether to change some aspects of a proposed project. Third is get a bank loan or issue shares to increase the company's working capital. Fourth is lend capital or invest in a company or project. In other words, become either a creditor or partner. 5 is buy or rent or lease production machinery. X is techniques. Financial analysts often compare financial ratios of solvency, profitability, growth, etc. So we have 3 performance of techniques. First is past performance. Across historical time periods for the first firm, the last 5 years for example. Second is future performance. Using historical figures and certain mathematical and statistical techniques including present and future values, this extrapolation method is the main source of errors in financial analysis as past statistics can be poor predictors of future prospects. Third is comparative performance. Comparison between similar firms comparing financial ratios is merely one way of conducting financial analysis. Financial analysts can also use percentage analysis, which involves reducing a series of figures as a percentage of some base amount. For example, a group of items can be expressed as a percentage of net income. When proportionate changes in the same figure over a given time period expressed as a percentage is known as horizontal analysis. Vertical or common size analysis reduces all items on a statement to a common size as a percentage of some base value, which assists in comparability with other companies of different sizes. As a result, all income statement items are divided by sales, and all balance sheet items are divided by total assets. Another method is comparative analysis. This provides a better way to determine trends. Comparative analysis presents the same information for 2 or more time periods and presented side by side to allow for easy analysis. Theoretical challenges. Financial ratios face several theoretical challenges. First, they say little about the firm's prospects in absolute sense. Their insights about relative performance require a reference point from other time periods or similar firms. Second is one ratio holds little meaning. As indicators, ratios can be logically interpreted in at least 2 ways. One can partially overcome this problem by combining several related ratios to paint a more comprehensive picture of the firm's performance. Third is seasonal factors may prevent year-end values from being representative. A ratio's values may be distorted as account balances change from the beginning to the end of an accounting period. Use average values for such accounts whenever possible. Fourth is financial ratios are no more objective than the accounting methods employed. Changes in accounting policies or choices can yield drastically different ratio values. That's all. Thank you.